Hi guys, welcome to the Perfect Portfolio. In this learning video, we will discuss the instruments of monetary policy of the Reserve Bank of India and we will understand how RBI controls the money supply in the economy. I am sure you would have seen such newspaper headlines and articles. But have you ever wondered what this headline means? How to interpret this piece of information? And how does it impact our savings and investments? In this learning video, we will cover what is repo rate, reverse repo rate, cash reserve ratio, statutory liquidity ratio, marginal standing facility, bank rate, and decode how changes in interest rates are used to control the money supply in the economy. Without any further ado, let's get started. Number 1. Repo rate. The interest rate at which the RBI lends out money to banks. The loans are provided to banks against the collateral of government and other approved securities. Currently, the repo rate stands at 4.4%. Number 2. Reverse repo rate. The interest rate at which RBI borrows funds from banks, so as to absorb the market liquidity and money supply. Currently, the reverse repo rate is 3.35%. In simple terms, repo rate is the rate at which RBI lends to banks, whereas reverse repo is the rate at which RBI borrows from banks. Number 3. Cash reserve ratio. CRR is the average daily balance of funds that a bank is required to maintain with the RBI. It is expressed as a percentage of the net demand and time liabilities of the bank. The CRR at the moment is 4.50%. Number 4. Statutory liquidity ratio. SLR is the proportion of NDTL that a bank is required to maintain in the form of safe and liquid assets such as government securities, cash and gold. The current SLR is 18%. This percentage of the deposits made by companies and public is to be maintained by the bank itself. Number 5. Marginal standing facility. MSF is a facility under which scheduled commercial banks can borrow additional amount of overnight money from RBI by dipping into their SLR portfolio up to a certain limit at a penal rate of interest. This provides a safety measure against unanticipated liquidity shocks to the banking system. The current MSF rate is 4.65%. Number 6. Bank rate. Bank rate is the rate at which RBI is ready to buy or rediscount bills of exchange, certificate of deposits, or other commercial papers. Bank rate is automatically aligned to the MSF rate and changes accordingly. Current bank rate is 4.65%. Now let's understand how the RBI uses all these policy rates to control the degree of money supply in the economy. RBI will simply raise interest rates when it wants to reduce the money supply and curb inflation. Likewise, if RBI wants to increase money supply in the economy, it will reduce interest rates. Changes to policy rates and reserve ratios have a direct influence on the availability of funds within the banking system for lending and borrowing. This in turn impacts the aggregate level of saving, consumption, expenditure and investment in the economy. Through these instruments under the monetary policy framework, RBI is able to regulate interest rates, money supply and credit availability, with an aim to achieve its primary objectives of price stability and inflation control. To check the latest RBI policy rates, reserve ratios, exchange rates and market news and trends, you can visit the official RBI website and find these details on the landing page as shown here. With that we come to the end of this video. So what are your views on RBI's monetary policy framework? Do you think the recent rate hike is justified as a means to control inflation? Do let us know your thoughts in the comments. Please subscribe to our YouTube channel for regular learning videos on finance and investing. Also, be sure to follow our social media handles. If you're enjoying the content and found this video useful, please drop a like and share it with your connections. Thanks for watching.